the market seems to be flip-flopping. Why is that?
Well, you know, the truth is, Lerato, everybody's like desperate for a reason to be cheerful, you know, for sustained confidence in something, but it just doesn't seem to be coming. I think that, you know, maybe at the mid-year stage, we thought that perhaps the worst was over, or things looked a bit firmer on the global context, but things have deteriorated. You know, people are definitely a lot more anxious than they were. And, you know, this in turn feeds through to frontier markets because they are less liquid. And, you know, when you can sort of get decent returns in the fixed income space right now, the incentive to move into less liquid markets remains, you know, less compelling than we would like it to be, is the truth of the matter.
When you talk about people tending to move into fixed income, which seems to be showing at least steady gains, any reaction by the market to the inflation figures that came out yesterday? Definitely they're showing us that Nigeria is at least on a good and solid footing.
Well, yes. I mean, this is the point. And I guess the point is if you buy a government bond, you know, even if, you know, there is some sort of volatility in the yield, you know, you have something that gives you a legally binding obligation, which you don't have if you buy an equity. And, you know, as we have seen, I think certainly for investors that still had positions in some of these target banks, for instance, realized, you know, through the nationalization process that they can very easily end up with nothing. And if you're an equity holder, you're at the bottom of the food chain. So, you know, when markets are as uncertain as these ones are, it's hard to make a compelling case for taking convincing and decisive positions in equity.
Well, effectively, we're in the middle of September, and we know that the 30th of September is looming for these mergers and acquisitions in these banks. We've had clarity on what Access Bank is trying to do. Do we have any more clarity on the Ecobank and Oceanic deal, for instance?
Well, we listened to a call with management yesterday, and our feeling was that they were perhaps earlier in the process, just in terms of really getting to grips with how they're going to integrate Oceanic Bank and how they're going to run the business, you know, going forward. I think there's still some deliberations about what they're going to do with subsidiaries, which to our minds ought to be something that is reasonably clear at this stage. I mean, they've already committed themselves to buying the bank, and then they're going to figure out subsequently what they're going to do with some of the subsidiaries. This as an example. So I think that also, given that you were looking at a relatively small bank in the Nigerian space, merging with what is a large bank but that has been struggling for the last 2 years, there were lots of concerns about the ability for ETI to sort of infuse its culture into a significantly larger organization. We're not saying it's not possible, but I don't think it will be easy. So I think, you know, they've guided 36 months on the Conservative side. They perhaps feel that optimistically they can do it in 24. But, you know, in terms of actually combining platforms, harmonizing the sort of thinking of the employees, you know, IT systems and the like. I think, you know, they've got their work cut out, without a doubt.
How do you envisage the banking landscape changing? Because effectively we're going to see some tier 2 banks post-merger becoming larger entities, effectively having an asset base the size of tier 1 banks. We're seeing some banks that have a very francophonic DNA, like Ecobank, entering this market like you're talking. What are we likely to see by way of what the landscape looks like?
Well, the way we see it, I think that there will be a kind of a window of maybe a couple of years for some of these mid-sized banks to really make their stamp on their strategy and demonstrate that they can execute effectively and deliver returns. I don't think necessarily that every single bank has to be the size of a tier 1 bank, but that is also assuming that we grow the overall pie. The challenge in this market is that the focus is still very corporate-centric. And because of that, you know, the ability to be able to sort of generate cheap funding and fund corporates that are few in number and very competitive in terms of pricing, you need to be, you know, a fairly large bank. But if some other areas in the economy, like agriculture, like even consumer, begin to develop for banks as outlets for credit, then suddenly you don't have to be a tier 1 bank. Right. You know, and we have tier 2 players talking about these things. So Diamond Bank, as we've discussed many times, is quite far down the road, relatively speaking, in terms of its consumer strategy. But it's not necessarily an across-the-board thing yet. So they need to demonstrate how they plan to survive in that middle market, and they probably have about 2 years to do so, while some of these new entities, you know, like Access Intercontinental or ETI, Oceanic, sort themselves out. But thereafter, we're looking at having 7 large banks that will dominate the asset base and the deposit base. And if they don't have a clear strategic positioning, then they will struggle, I think.
And a final question, Rele. I think a lot of people watching from outside are concerned about one issue, and that's safety. And let me elaborate on that. It's the issue of once these banks have merged, shareholding has shifted and changed. What are we talking about in terms of capital adequacy and just meeting the new regulatory requirements and just dealing with banks that are financially sound?
I think that it's a valid point to raise. As we know in this market, the capital adequacy ratio requirement from the regulator is 10%, but we've always felt there's an unspoken level of 15, below which I think banks will be penalised. I think that for the most part, the banks in this environment have typically held very high levels of capital, and I think that the combined entities on the whole should be in reasonable shape in that regard. But actually the ETI Oceanic transaction is the one perhaps that we are looking at a bit more closely, because we feel that they may well be closer to the wind than others. But there will certainly be a significant number of banks to choose from that will have more than enough capital. I expect First Bank to raise capital in the not too distant future, and maintain capital adequacy in the teens as a sort of a comfort level in the very least, well above the 10% minimum floor that the regulator requires. So we're not overly concerned about that for now.